Hi everyone, welcome back to Canada Accounting Insights. Today we're going to break down two really important and sometimes tricky areas of revenue recognition: royalties and warranties. These are topics that trip up CPA students and even experienced accountants because the rules under IFRS 15 and ASPE 3400 can look similar at first glance, but the details matter. By the end of this video, you'll understand not only the accounting treatment, but also the why behind it, so you can confidently apply this knowledge in exams and in real practice. Before we dive in, don't forget to hit that like button and subscribe so you never miss out on new videos that will help you master accounting, finance, and taxation concepts. Let's start with royalties. In simple terms, royalties are payments that a company receives when someone else uses its asset, usually intellectual property like patents, music, books, or mining rights. Think about a book publisher earning a royalty every time a copy of the book is sold. Key question: when do we recognize revenue from royalties? Under IFRS 15, royalties are a variable consideration. That means we can't always recognize revenue up front because the amount depends on future events, like sales volume or usage levels. Revenue is recognized only when it's highly probable that there won't be a significant reversal later. In other words, at the later of the following events, subsequent sale or usage occurs. The performance obligation that the royalty relates to has been satisfied. For example, if an author is entitled to 10% of book sales, the publisher can only recognize revenue as the books are actually sold, not when the contract is signed. Now, under ASPE 3400, the principle is similar but less prescriptive. Revenue is recognized when the performance is achieved amount is measurable and collection is reasonably assured. So, IFRS has more guidance about uncertainty and variable consideration, while ASPE is principle-based. Example: suppose a mining company licenses extraction rights and earns $2 for every ton of coal extracted. If 1,000 tons are mined this year, the company recognizes $2,000 in royalty revenue in that period. Now let's look at the accounting entries. When royalties are earned, you record debit, accounts receivable or cash; credit, royalty revenue. If royalties are received in advance, you don't recognize them right away. Instead, you record debit, cash; credit, unearned revenue, a liability. Only later, as royalties are earned, you transfer from unearned revenue to royalty revenue. This is a great exam point because many students forget that cash received is not always revenue. Now let's shift to warranties, which are another classic area where IFRS and ASPE diverge. A warranty is basically a seller's promise to repair, replace, or refund if a product doesn't perform as expected. There are two main types: assurance-type warranties. These are bundled into the sales price. Think of a 1-year standard warranty on a laptop. Service-type warranties. These are sold separately, like when you buy an extended 3-year protection plan at checkout. Here's the key difference. For assurance-type warranties, no separate performance obligation exists. The cost of honoring the warranty is estimated and recorded as a liability at the time of sale. For service-type warranties, you actually have a separate performance obligation. That means you defer the revenue and recognize it over the coverage period. Let's run through the entries with examples. Assurance warranty, example. A company sells 1,000 laptops at $500 each, with a standard 1-year warranty. Based on past data, warranty claims are expected to cost $10,000. At the time of sale, debit, cash $500,000. Credit, sales revenue $500,000. Debit, warranty expense $10,000. Credit, warranty liability $10,000. Later, when actual warranty costs are incurred: debit, warranty liability; credit, cash/inventory/parts. Service warranty. Example. Now, suppose customers pay an additional $50,000 for extended warranties. At the time of sale, debit, cash $50,000. Credit, unearned revenue $50,000. Then, each year over the warranty period, you recognize a portion as revenue. All right. And here's where students and professionals often get tripped up. Let's check some differences between IFRS and ASPE. IFRS, specifically IFRS 15, requires identifying performance obligations, so extended warranties are clearly treated as separate revenue streams. ASPE, on the other hand, doesn't have the same detailed guidance. Generally, assurance warranties are recorded as liabilities, and separately priced warranties are recognized as revenue over the service period. So while both frameworks lead to a similar result, IFRS requires more explicit identification and disclosure of obligations. Now, why does all this matter? For exams, it's about showing the marker that you know the difference between assurance and service warranties, and how royalties tie into variable consideration. For real life, companies need to ensure they aren't overstating revenue. Regulators and auditors will focus on whether revenue has been properly deferred or recognized. Misstating royalties or warranties can materially affect profit, so understanding these rules is essential for compliance and decision-making. So to recap, royalties are variable consideration, recognized when earned. Warranties can be assurance cost provision or service-deferred revenue. IFRS is more rules-based, while ASPE is principle-based, but both aim for faithful representation of revenue and obligations. I hope this breakdown makes royalties and warranties a lot clearer for you. If you found this helpful, don't forget to like, share, and subscribe to Canada Accounting Insights. And let me know in the comments, which do you find more confusing in practice, royalties or warranties? Thanks for watching, and I'll see you in the next video.